All right, we're here today to talk about the 5 functions of markets, intermediaries, and institutions. We're here with Sean and Adam, and tell us a little bit more about it. Go ahead, guys.
I'll let you start with your DSUs and SSUs.
All right, going off the first topic on there, transporting cash across time. Sean's gonna show you guys, or he's gonna talk to you about how that relates to those who we refer to as surplus spending units, and then those who we are going to refer to as deficit spending units. Surplus spending units being those who have extra cash on hand and they're looking to loan it to, or not loan it, but get it to those who are in need of cash at the time. Sean?
I'll step in. All right, so our surplus spending units, basically what they're looking for investments, okay? Whether it's putting it in just, your borrowing account at the bank or deposit account, I should say, or as far as actually buying securities and bonds and whatnot. So what we like to think of as the surplus spending units are actually of households. So Adam and I may have a job and we may make a lot of money someday, hopefully. And what's going to happen is we're going to have all this extra money and we won't know what to do with it. So we're actually going to give it to this third party, which are our intermediaries. Other than that, zoom in on that would be like institutions, markets, different funds, stuff like that. So what happens is we'll take this surplus money, put it all the way to the third party, and they're going to look to do something with our money. Okay, so the best example is that Adam and I are going to give our money to the bank. We're just going to put it in our bank account, and we're going to hold it there, and we don't get much interest on that. But hey, we're still earning something, I guess, if you want to say that, or we can put it in CDs or whatever. But what's going to happen is this DSU at the same time is looking to this third party for a loan. So say this DSU is a new company in town, and they end up wanting to really buy the factory down the street to make shoes or something like that. So what's going to happen is they're going to look for a 30-year mortgage. So they go to that third party, and hey, Adam and I have been forking money over. So this third party already has all this cash that they can actually loan out and give to this DSU. And the nice thing about this, the way it works so well, is that these third parties are so good at pooling money that it's not just Adam and I that are giving them money, it's everybody, right? So if Adam and I want to take our money out of our bank account, we can, because these third parties have reserves too. And that's how we can get away with giving them a 30-year loan. So if you want to think, this arrow here could actually be a 30, and say Adam and I hold our money in there for only 1 year. And that's what's the cool thing about this and how it makes it work. So that's why we have that as our number one, transport cash across time.
Right. And just to mention that third party there, the intermediaries, that's their entire way of making money. That's how they go about doing business. They make money by connecting those who have money to those who are looking for it. Yeah. And that basically summarizes your first function there.
Yeah, the best example is say Adam and I earn, say, 1% on our bank deposit, and then this DSU is actually paying probably like say 6 to 10%. So that's an example. That's how that transaction in there is actually making the third party money. So do you want to get back to our board and take a seat? Cool. So what we have for number 2 is the risk transfer and diversification, and I'll let you describe that since you're good at that.
Okay. For number 2 here, the risk transfer diversification is if you're just an everyday person collecting your paychecks and you're looking to do turn your money over and maybe grow it a little bit. What you do is you look to an intermediary, and what they'll do is they'll take on the risk of holding your money, and you tell them what you plan on doing with it or what you look to do with it in the near future or distant future, and they'll assume whatever risk goes with that strategy, and they will go about either diversifying it for you, or they will do something as simple as putting it in a checking account. Something that should be said here, a good way or one of the more recent strategies of diversification is through foreign exchanges or even futures and forwards. That's. Do you have anything to add to that?
Yeah, technically that's what it's known as hedging your risk. So the best thing to look at is say for a future contract Or actually, let's do the option contract. So say Adam and I want to buy an option for, I don't know, say we like our corn, so we're going to try to buy it cheap. So we're going to go to that commodities market and we're going to buy that option. But we know that sometimes if there's a shortage on corn because of bad weather, it could get really expensive. So say we're in December and we're looking to get a nice rate on that corn, we might buy what is called an options contract, which is actually just basically an insurance policy in case that price changes so much. So if Adam and I buy a contract for, say $5 for a contract, and our contract's going to say if corn is, we'll buy a bushel of corn at $30. And keep in mind, I have no idea what corn prices are at, so I'm just making this up. But say a bushel of corn, we're going to sign on at $30 for that contract. So we're giving up that $5. But after that, what's going to happen is it's going to come, say that contract's up in August, that option, and it's corn season and we're loving it. And the price is now $50 for one bushel of corn. Adam and I actually get to buy it at $30. So it's pretty cool. That's how options work. But fixed income is the same way. We can actually, it's a way of hedging our risk, and that's the actual term, is we hedge our risk. And we're insuring ourselves, we're helping ourselves out doing this. So foreign exchange, if we're worried about, I could put money in the euro to help me in the U.S. currency as well. So it's how those act on each other,
Right,
I guess
right.
you'd say.
And we're talking the tip of the iceberg right now. There's so many methods right here for that intermediaries use to
Yes.
diversify and even to hedge, like you said. And what we should mention is that as information and technology has been evolving here, it's been getting easier for the everyday individual to diversify their own investments.
Yeah.
So that's I'm guessing that it's gonna make it much harder for intermediaries to gain business from those looking to grow
Yes.
their money. They're gonna have to find a competitive advantage that I don't know where it's gonna come from, but just let it be known, or that's something you can look at going forward. That
We're also looking at things becoming more globally. So as that happens, we're actually diversifying as well. So if Adam wants to, Brazil's an emerging market, so he might want to start financing in or investing in Brazil. So there's things known as ADRs that actually sell in our markets that Adam can buy up, and it's actually, so he's buying it on our exchange, but it's actually driven by what's happening in Brazil, which is pretty cool. So that's another way to diversify. So the things are just, there's so many options out there, and that's the important thing to know. But also I wanted to talk briefly about exchange traded funds, or ETFs. The cool thing about these are, say we want to own every single stock on the S&P 500, and you know what, I can't afford it, but I might find that there's an S&P ETF. So the cool thing about that is that this pool of funds is buying every single stock within that S&P 500, and I might only have to be able to put $100 in, but I'm completely
you're exposed
yeah,
to
I'm
everything
exposed to
that's going to go
everything.
on in that market.
exactly.
So if you have a good feeling about the S&P, just the economy in general, you don't have to go in and buy one of every stock. You can buy a share of this ETF, and you'll get that exposure.
Exactly. Well, I think we talked a little bit about that we can move on, I guess I could say.
Number three. Number three here is liquidity. It's probably something you're familiar with. Financial intermediaries go about, they obtain your funds, and depending on what intermediary you go to or what avenue you choose, your funds are going to be either pretty liquid within the vehicle that you choose,
Yep.
or they're going to be tied up for a little while. They're going to be a little less liquid. An example of a pretty liquid investment with an intermediary would be if you bought a share on the New York Stock Exchange or on the whatever Dow, S&P, whatever. If you buy a share of a stock, say Apple, and whatever it's trading for, $400 or whatever it is, and you buy that stock, and then 3 months down the road, you say, all right, I need some cash pretty quick. I gotta pay my rent, whatever. You can go ahead and almost instantaneously find a buyer, sell that, get your $400, Um,
Well, the important thing is that we're not finding a buyer. That's what the financial intermediaries do. So we have accounts. We have that E-Trade. We might have that Scottrade account. We might have a broker, a family broker, say,
Right.
you know. And the nice thing is, I tell my broker I want to sell my stock. He pushes that on. And the nice thing about the markets, say the New York Stock Exchange, we have a stock there. The brokers that are sitting on the New York Stock Exchange, they have to take our trades, which is pretty cool. So that just shows you that how liquid intermediaries make things, and it's
Right.
very important.
so in that situation, the intermediary would be the market.
Yes,
Correct?
Yep.
Okay.
And we can look to banks. We used our example on the board with the DSUs and SSUs. If we were to use bank deposits, I can go to a bank tomorrow and get out my money if I need it, and that's important. Yeah, everyone talks about the Great Depression, but at least the FDIC does ensure our cash in the bank, so that's important. And what else can we talk about? Liquidity. Laura, do you have any suggestions on liquidity?
You're good.
We're good? All right, so let's move on to the payment mechanism. And the important thing here is that it's really defining what a third party is. So if Adam, we use the whole mortgage. Say Adam wants to buy a house. You know what? He can't finance this house, so he has to go somewhere for this for the money, and he's going to go to a real estate agent or a bank and talk about this whole 30-year mortgage, and they're actually going to go out and find that money for him. And over time, Adam's going to pay that bank or whoever gives him the loan, and that's basically what the payment mechanism is. And that's a very interesting topic too. If you want to learn more about mortgages, I would definitely read up on the mortgage bond crisis, and that talks about third parties the whole way, and they actually talk about derivatives and that with credit default swaps and insurance, which is basically an insurance policy, which is really neat.
Right.
Do you have anything to add to that?
I mean, the payment mechanism, if the intermediaries weren't around, it would be up to you to show that you have the ability to make these payments, and that you'd be on your own to find the funds to make these payments.
That's a good point.
And it just shows just another one of the functions that they.
That's
They
why
take
the
on.
bank's the best idea. They pull so many assets together that they actually can make loans the way they do.
Right.
Laura, do you have anything to add to that?
No, just that it's important. Without banks, you wouldn't be able to write checks or pay things with ETF or EFT, sorry.
Oh yeah.
And you would be running around with really fat wallets because you wouldn't have credit cards, and you'd only be able to pay in cash.
Yeah.
So if you had to pay for a car, you would need a whole lot of money in cash to take with you to the car dealership. And he would need to have a really big place in his building to hold on to the cash that he received from the car. But because we have banks, we can all write checks or charge things. And that's why I think the intermediaries perform a really important function.
That's a great example, because going back to that, the bank that I did work at, the funds transfer, we get like trillions of dollars a day, a couple trillion. So that just goes to show how massive it can actually be. That's with technology too. It's so much easier now. Like you said, the exchange fund transfer, electronic fund transfer. It's very makes things so much easier. So with that said, let's roll on to number 5, which is information. And the nice thing about information is when we talk about intermediaries, they provide all the information to our deficit spending units. They provide information to our surplus spending units. The nice thing is too, you can read up on any stock you want whenever you want. They Securities Exchange Commission actually makes a lot of all the companies that are publicly traded come out with what are called their 10Ks, and that basically gives you the whole report of all their financials, and so you know exactly what you're investing in. And like what a broker would do, they actually give you examples of what you might want to put your assets in, whether it's value stock or growth stocks or stuff like that. Do you have anything to add to the information?
I know with a lot of intermediaries, if you have your money with them, like a bank, mutual fund, whatever, if you go in and you're concerned about your investment and you have questions or comments or whatever, they'll have information there for you to show what's been returning in your investment and what hasn't and why. If they weren't there, it'd be on your own to do the analysis almost as to why you're gaining money or why you're losing money, and what's the best position going forward.
And that's the cool thing too. With technology, like we keep talking about, services get more and more competitive, and what a lot of these intermediaries are trying to do are just to provide as many services as possible, because it gets you that client base. So I mean, they're producing graphs for you, and like you were saying, and it does help a lot. And we will talk later on the semester about efficient market hypothesis, and it'll be a fun topic for sure. So Lori, how about, you want to add anything, or?
Just that you wouldn't know how much to pay for Apple stock if you were dealing directly with Steve Jobs' estate.
Exactly.
But because there's a market there, you know that Apple stock should cost about $400. And so the market actually helps you set a price.
That's a very good point, indeed. So, I think that's about it with the 5 functions.
Good job, gentlemen. Thanks.